really what I want to go over is the process, and it's pretty well laid out in this slide. Again, the common question is, what do I need to do to become successful in trading? And I want you to really take this very seriously, because it's gonna involve some work. So when I refer to the process, I'm referring to really effectively what is laid out in this slide. So another common question that we get is that when one listens to a successful, presumably successful trader, or if one is trying to copy or learn from somebody else's model, or try to effectively copy specific parameters from somebody else's model, one often thinks that the professional trader is holding something back. And ultimately what they're holding back is something that quite simply cannot be shared, and is the internalization of details that are retained from market experience. So, well, what do you mean by market experience? Is market experience just simply taking a trading, call it a system, putting it on my computer and sitting there and watching it for hours on end, waiting for my next trade? Well, it actually, what we do want to do is we want to go a lot deeper than that. And this is really ultimately what we want to lay out before us. So if you're pulling up your charts, pulling up your brokerage account, and you've got a set of parameters laid out that you have reasonably established that these parameters can establish a certain level of probability, it's very important that you have a pretty deep understanding of each of the parameters that you're using. And when I refer to parameters, I'm pretty well referring to everything that's laid out here, and I'm going to walk through it for us. So let's just look at the three kind of primary categories: the fundamentals, the technicals. In my case, I use price behavior, and of course the psychology. But let's break this down, because each are held separately, but they're also effectively commingled, or basically webbed together. So when we refer to the fundamentals, it's really quite important that even though you may call yourself a technical trader, or you rely 90% on technicals to guide your trading decisions, position management, your risk model, it's really quite important to understand the framework of the market from a fundamental perspective as well. And when we refer to fundamentals for foreign exchange, it's very important to have an understanding of monetary policy, and what they refer to these days, kind of the catchphrase, is forward guidance. Monetary policy positioning within the context of its own region or country, as well as how monetary policy is positioned in relation to other countries and other regions, and the shifts that are taking place, which typically is reflected in interest rate spreads. So monetary policy is more the broader framework from the fundamental perspective. And of course, the constituent parts of monetary policy are going to be the data events, as well as the policy statements. So when we break monetary policy down, it's going to be established, or the direction is going to be established, or the forward thinking of the market is going to be established through the stream of data that comes out. Now, if you're day trading, for example, it's important that you understand, even though your decision guiding parameters may be technical with whatever type of formula that you use, it's really important that you have a good sense for what, from a policy perspective, what the flavor of the month is, or the flavor of the cycle of where we are with the economy. It might be jobs, it might be housing, it might be broad-based growth, but to have an understanding of the data, because depending on where we are in the cycle, the data, of course, is going to drive price, which you're going to see technically, and you're going to need to make a decision on, in one capacity or another. So to understand data in depth in terms of what type of volatility it can potentially drive, getting an understanding for the market response to the data as it pertains to the broader fundamental perspective, even though your trading may be technically guided. So this is going to establish the overall environment of the market, which is going to generate a market response, because the market response may be in contradiction or in opposition to whatever the data suggests. And that's important to understand, because over time, if you establish parameters or a structured manner in which you're going to come to understand or build a tight acquaintance with the market or tight connection with the market, you're going to obviously see that we see this repeated day after day, week after week, month after month, year after year, and you start to identify the patterns and the shifts in the market. And that's going to change the environment, which changes the market response. And when we talk about the market response, we're seeing that right now. For example, with volatility is very, very compressed. Volatility is very low right now. And so you may have a trading approach that you can adjust to the low volatility, or you may not. I know with the approach that I take for intraday trading with price behavior, we're able to very, very quickly and effectively adapt. Now, perhaps another question that I also get is I want to trade longer term positions because I don't have time to sit at my computer and take on intraday movements. Then that's going to weigh more heavily on fundamental factors, of course, because for my personal position trading model, I will look at the fundamental drivers, where we are positionally from a fundamental perspective in relation to the various crosses, but I'll manage it technically. Okay, but the fundamentals are already some of the main factors I'm looking at in terms of what's driving trend in FX flows. So we have the fundamentals, so it's important you establish a protocol to break this down, to very, very specifically study the volatility response of the market in relation to the level of interest and connection of fundamentals in the market, what type of environment it's establishing, and the market response that it can generate. Now, what I'm going to do, I am going to talk a little bit, and in a moment I'm going to show you another slide that speaks more specifically of technical. So I'm going to give you an example of exactly what I'm referring to here. And once again, so let's say, for example, somebody gives you a fundamental trade call, and I'm referring back to this internalization of details retained from market experience. So if you hear of a trade recommendation to buy a certain currency or sell a currency based on someone's fundamental view, now their fundamental view is going to be established on a different set of parameters, because they will have internalized details from market experience and market knowledge from quite a different perspective. And which is why you need to go through this process yourself in order to establish more accurate parameters. Okay, so, and that not only applies to the fundamentals, but the other areas as well. So very, very important to really go through. When you engage in the process, you will internalize behaviors to a level that cannot be taken away from you. So if you're just out trying to copy somebody else's model, then there are too many missing pieces. It's really just an empty vat, and you have very little information and reference points to draw to guide good prudent decisions throughout the process of selecting and managing trades. So by the nature of going through this process, even if you take only a fraction or use only a fraction of the information to guide decisions, it is going to be a very, very profound component of your trading decisions.